So welcome to our panel discussion on unconventional monetary policy, tools, effectiveness and implication. As we know, central banks around the world have increasingly rely on unconventional monetary policy too, especially in times of crisis when traditional interest rate adjustments are no longer effective. So today we will explore some of the tools like quantitative easing, negative interest rate, yield curve control and forward guidance, and their real-world application and their implication for economy globally. So let's begin by introducing our panelists. We have Sanjay, Central Bank Communication Expert, Tsawangamo, Asian Financial Stability Researcher, and Sanjay, European Economic Policy Advisors. So now let's begin our panel discussions. Before we begin our core panel discussion, let our panelists to introduce on the topic. So could you go first?
Thank you, moderator, for the opportunity. So, greetings to everyone. Today, I will be focusing on the two key unconventional monetary policy tools, that is for guidance and the yield curve control, both of which plays a critical role in shaping the market expectation through the communication strategies. So, forward guidance refers to the practice of central bank clearly signaling their future policy intention to influence the investor behaviors and stabilize the economy. For instance, in the aftermath of 2008 financial crisis, the US Federal Reserve pledged to keep the interest rate near zero of an extended period. This commitment helped to reassure the market and support the recovery by anchoring the expectations. The success of forward guidance largely hinged on the central bank credibility and clarity of the communication. Meanwhile, the yield curve control employed notably by the Bank of Japan since 2016, which aims to directly manage the long-term interest rate by targeting the specific yield on government bonds, such as capping the 10-year yield around 0%. This tool complements forward guidance by reinforcing the expectations across the different maturities, allowing the continued economic stimulus without constantly expanding the central bank balance sheet. Together, these tools help to guide the market behavior across the short-term as well as long-term horizons.
Thank you, Sanjay. Now let's hear some insight from our panelist, Sanjay.
Hello everyone. Today I will be discussing on quantitative easing and unconventional monetary policy tools involving large-scale purchase of government and private sector securities by central bank. The primary goal of quantitative easing is to inject liquidity into financial systems, lower long-term interest rates, and stimulate economic activity, particularly during the time of crisis. For example, the European Central Bank launched a major asset purchase program in 2015, acquiring over 2 trillion euro in assets to fight deflation and promote growth across the eurozone. Similarly, the US Federal Reserve expanded its balance sheet from under $1 trillion in 2007 to over $8 trillion by 2022. While quantitative easing can help stabilize financial markets and reduce borrowing costs, it also poses a significant risks such as inflation, asset prices, wealth inequalities, and complicating monetary policy exits, as evidenced by the bond market volatility in 2022.
Thank you, Sanjay. Now let's go with our next panelist, Tsawangamo.
Greetings. First of all, thank you for the opportunity. And today I will be exploring negative interest rate policies, a bold and unconventional approach used by the central bank like the Bank of Japan and the Swiss National Bank. Since 2016, Japan has maintained a negative policy rate of negative 0.1 to encourage banks to lend more and consumers to spend, with the broader goal of overcoming persistent deflation. In Switzerland, negative rate has also been used strategically to weaken the Swiss franc and support export competitiveness. While such policies can offer short-term benefit, they come with a serious trade-offs. Negative rate compress bank profit margin, alter saving and investment behavior, and may fuel asset bubble due to excessive risk-taking. Moreover, uh, there's the danger of hitting the reversal rate, a threshold beyond which further rate cuts can reduce rather than increase credit supply. This experience shows that while the negative interest rate have a great effect in the most developed economies, it also carries with us some financial risks and disadvantages with it.
Now, thank you for all panelists for your insightful introductions. Let's now move to into deeper panel discussions on our topic unconventional monetary policy. So I will direct questions to each of you, but please feel free to add your perspectives as we go further. So forward guidance has been widely used by the US Federal Reserve and the European Central Bank. So in your view, how do that forward guidance and yield curve controls the market expectations and what determines their success?
So the effectiveness of the forward guidance and the yield curve control ultimately depends on the two critical factors, that is the credibility of the central bank and the clarity of its communication. So for example, during the period from 2008 to 2014, the US Federal Reserve successfully anchored the market expectation by considering signaling its intention to maintain the low interest rate until the economy showed sign of recovery. This clear and steady messaging reassured the investor and helped to stabilize the financial markets. Similarly, Japan yield curve control introduced in 2016 enhanced the forward guidance by targeting a specific long-term interest rate, specifically keeping the 10-year government bond yield around 0%. So this allowed the Bank of Japan to continue supporting the economy's growth with constantly expanding its balance sheet as was the case of quantitative easing. So however, both the tools are highly sensitive to changing economic conditions. If the inflation suddenly rises or if the market begins to doubt the central bank commitment or ability to follow through, the credibility of these policies can be undetermined. In such cases, rather than stabilizing the economy, the forward guidance and the yield curve control can lead to market volatility, uncertainty, and reduce the policy of effectiveness.
Thank you. Thank you so much, Charan, for your wonderful answer. Now, next move on with our next panelist, Sai Charan. So, quantitative easing has been a cornerstone of unconventional policy in US, UK, Eurozone. So, how has this quantitative easing influenced the long-term economic condition, especially in US and Eurozone?
Thank you for the question. Quantitative easing has been profound impact on the long-term economic condition, particularly in the United States and the Eurozone. Following the global financial crisis and again during the COVID-19 pandemic, central banks like Federal Reserve and the European Central Bank deployed quantitative easing to inject liquidity into the financial systems, lowering long-term interest rate, support lending and investment. These measures were effective in restoring financial market stability, encouraging borrowing, and preventing deflation. However, quantitative easing also produced some unintended consequences. In United States, for example, the prolonged period of ultra-low interest rate contributed to 40% surge in housing price between 2020 and 2022 as a cheap finance fueled demand in real estate markets. This created affordability issues and widened the wealth gap since rising asset price disproportionately benefited the individual who already owned the homes or financial assets. Another major challenge is the process of exiting quantitative easing, known as a balance sheet normalization. When the Fed began tighten monetary policy in 2022, including rising interest rate and unwinding asset purchase, it triggered volatility in bond markets. The sharp rise in yield affects the valuation of fixed income securities, contributing to the collapse of institutions like Silicon Valley Bank, which was heavily exposed to the long-dated government bonds. This event underscores that while quantitative easing is effective crisis management tool, it is not without long-term trade-offs, including financial stability, inequality, and complex policy reverse dynamics. Thank you.
Thank you, Sanjay. So next, when we shift our gears, our next panelist, Solomon. So there, earlier you shared about the negative interest rate. So there is several advanced economists have experimented the negative interest rate to combat deflation and boost lending. However, the long-term implications remain uncertain. So in your views, are negative rates sustainable in long run?
Thank you for the question, moderator. Negative interest rate, while useful in the short term to combat deflation and stimulate economic activity, they are generally not sustainable as a long-term policy. One of the main drawbacks is that their impact on bank profitability. Commercial banks typically earn profit from the spread between the interest they pay and on deposit and interest they receive from the loans. When the rates go negative, this margin shrink, sometimes even turning negative, making it harder for the bank to operate efficiently. For example, now take Switzerland as an example. To offset the losses, many banks began charging large institutional clients for the deposit while shielding everyday servers to avoid public backlash. Even so, this creates distortion in the financial system, discouraging traditional saving and encouraging riskier investment behavior in search of higher return. In Japan, despite years of negative rates, the demand for the credit remains sluggish. Households and firms, rather than borrowing more, often choose to pay debt or hold cash in uncertain economic conditions. This indicates that negative rates may have limited effectiveness in stimulating real economic activity once broader structural issues like aging population or weak domestic demand are at play. Additionally, there's the risk of hitting a reversal rate, the point at which further reduction in the interest rate actually reduces bank lending, undermining the very purpose of the policy. In essence, while negative interest rate can provide short-term relief during economic downturn, they are not a viable long-term strategy. Their continued use can damage financial institutions, distort capital allocation, and contribute to systematic vulnerabilities, particularly if not accompanied by the fiscal support or structural reforms.
Thank you, Solomon. Now, in this round, let us delve further into how these tools influence broader economic behaviors. So, sound students. So, considering the heightened uncertainty and geopolitical risks, how do forward guidance and yield curve control affect the long-term investor confidence and economic decision making?
Good question, moderator. Especially when the market faces high uncertainty or geopolitical risks, both the forward guidance and the yield curve control can serve as a critical tool to anchor the expectations, especially during the uncertain time. Forward guidance helps the market to plan by offering a transparent view of future monetary policies, which is essential when traditional signals become unclear. During a pandemic or geopolitical crisis, for instance, the Federal Reserve guidance in 2020 reassured the investor that interest rate would remain low, which stabilized the bond market and encouraged the long-term investment. And the yield curve control, by targeting specific bond yield, reinforce the forward guidance message and reduce the volatility in the long-term interest rate. Japan experience shows that the yield curve control can preserve or investor confidence in a low inflation environment. However, if geopolitical shocks create inflationary pressure, both tools face credibility risks. If central banking appears slow to react, confidence could erode, leading to a sharp correction in the bond market. Therefore, the tools are effective but must be flexible and backed by trust in central bank commitment and transparency.
Thank you, Sean. Now turning back to our panelist, Centurion. So while impactful in lowering interest rate and boosting liquidity, also transform the market behavior, how that quantitative easing altered the action of financial market and private investor over time, and what does this mean for the central bank credibility and financial stability?
Quantitative easing has profoundly altered financial market dynamics by flooding our systems with liquidity and driving down yields. Quantitative easing has pushed investors towards the riskier assets, including stock, corporate bonds, and even cryptocurrency in some cases. This surge for the yield contribute to record high in equity markets and real estate, but as also raised the concerns about asset bubbles and overvaluations. In terms of central banks' credibility, quantitative easing has initially enhanced confidence during the crisis by showing a strong policy response. However, the long-term reliance on the quantitative easing without a clear exit strategy has raised questions about whether the central banks can deteriorating the market signals and overextend their mandates. The Fed tightening in 2022 and its role in triggering volatility, including the collapse of Silicon Valley Bank, illustrate the difficulty of managing market expectation after prolonging interventions. The key implication is that the central bank must be transparent, gradual and data-driven when unwinding quantitative easing, or the risks undermining both stability and trust.
Thank you. Now our last panelist, Song Namo. So negative interest rates remain controversial, and looking at the long-term application in countries like Japan and Switzerland. So what implication does such policy have on household saving behavior and bank innovation, and could this shift in traditional role of commercial banking?
Once again, thank you for the opportunities, moderator. Negative interest rate challenge traditional economic behavior. In countries like the Japan and Switzerland, households have become more cautious, often choosing to hold cash or reduce spending out of concern for the future. Paradoxically, instead of stimulating consumption, negative interest rate policy can sometimes reinforce a culture of saving, especially where there is already economic uncertainty. For the bank, negative interest rate policy has forced to innovate. With the reduced margin, they have turned to fee-based service, digital banking, and even selective charging depositors. Over time, this could shift the role of bank from simple credit intermediaries to service-oriented platform focusing on the wealth management and the fintech solutions. However, this also means small banks may struggle, widening the gap between large and small institutions. Overall, while the negative interest rate policy can be short-term fix, its long-term use may require restructuring the banking model entirely, which is complex and risky transformation.
Thank you, Tom. As we begin to wrap up our discussions, I would like to invite each of you all to briefly reflect on the long-term risks of relying on unconventional monetary policy, and what key trade-offs should the policymakers keep in mind as they shape the future strategies. So now let's go with
That's all.
Regarding the forward guidance and the yield curve control, central bank risks losing credibility if they fail to follow through or must change course suddenly. A strong commitment can reduce flexibility, and unclear message may confuse the market. It's a low-cost tool but relies on clear communication and trust.
Negative interest rate hurt the profit and lending capacity, and it may encourage saving instead of spending and push the investor towards risky asset. And it can fight deflation, but the risks financial stability and market health.
Quantitative easing can inflate asset pricing, increasing inequalities, and make market relying on central bank support. Accelerating quantitative easing makes market turmoil. It boosts growth but may deteriorate financial markets and policy effectiveness.
Thank you.
Once again, I would like to thank our panelists for your valuable insights and to everyone in the audience for being part of today's important discussion. So our course of these sessions, we have taken a deep dive into the world of unconventional monetary policy, and we examined the key tools, forward guidelines, quantitative easing, negative interest rate and yield curve controls, and discuss how they have deployed in major economies to stabilize markets and influence expectation and support a recovery during the economic stress. And these instruments have shown their power in times of crisis, but also care a complex trade-off from central bank credibilities and communication clarity to the risks of market distortions and financial instability. The long-term success of these tools depend on the thoughtful implementation, transparency, adaptability to changing economic conditions. What emerged clearly is that while unconventional monetary policy can offer temporary reliefs and guidance, they are not a cure-all. So policymakers must remain vigilant, continuously assess risks, and work in coordination with the fiscal institution to ensure sustainable outcome. As we wrap up, so I hope today's conversation has enriched your understanding of the evolving role of central bank and the careful balance required in applying the powerful and yet nuanced policy tools. So thank you again to all our esteemed panelists and to all of you for your engagement, and we look forward to continuing this conversation in future forums. Thank you.